It's showtime. Hey there, guys. This is Mike Durr, Kingwood Mortgage Guy, and I am here for our regular Wednesday evening at 6 p.m. Talk about getting into homes, figuring out what the deal is with uh, credit, what the problems are with buying a home, what rates are doing, all that kind of stuff. And normally I have my lovely bride with me, but this week Sandy's not going to be here. So I'm on my own. And I guess I'll do the best I can. And for those that are watching and just left, I get that. So, but anyway, I think I've got a really good subject, and I don't think it's going to take too long tonight. It's called Unlocking Home Ownership, Navigating Mortgage Options for Self-Employed and 1099 Workers. So if you guys are ready, and I see that there are a group of people there that are here, we're not going to waste any time. We're going to get started right now. So let's rock. So unlocking home ownership, navigating mortgage options for self-employed and 1099 workers. And of course, Mike and Sandy Durr, that is me. And I will be going through this process of the kind of the whole thing about self-employed stuff. And I kind of like this. So here's what we're going to cover tonight. We're going to talk about the challenges faced by small business owners and 1099 employees. Like I misspelled employees, but that's okay. Tax write-offs and low reported income, impact on loan eligibility, alternate loan options and solutions. We've got a handful of those. Financial planning and preparation, conclusion, and question and answer. So save your questions to the end, and we'll try to go through those when we get there. Alrighty. So why be in business for yourself? Well, obviously there's the freedom and autonomy of being self-employed. That means that you basically are your own boss. I like the picture of this girl. I can do it better, faster, smarter, and for less. That's a good reason to be in business. Passion and purpose. I mean, the key thing I believe is that if you have a passion for what you do, you should be doing that. Because when I come to work every day, I don't feel like I'm coming to work. I feel like I'm coming to where I just need to be. Financial freedom, well, there can be that. Creativity and innovation, absolutely. Let me just look at something here. There we go. Flexible lifestyle. When you're your own boss, you can go and come as you please. That's something that we all appreciate. Legacy building. Legacy building is really about building something for the future, for maybe your family or your children to take over. So that's a big one. And the one that you can't read there is the opportunity for growth. I mean, I have the occasion to hang out with some guys that started a small mom and pop business and grew it into a massive corporation. And boy, I tell you, it's a lot of fun, and things really change when you do that. So all those are good reasons. The big one is money, time, and passion, I think, are the key ones. So there are a few negatives of self-employment, and the slide that I've got here may not reflect what I wanted to, but what I was trying to get at is, one, there's inconsistent income, particularly when you're starting out. You never know. I mean, every time you complete a sale, you're unemployed until you get another sale. Lack of employee benefits, you got to provide for yourself. And for a lot of people, you can tie into other companies' benefits in some cases, but that's one of the big ones. No work-life balance. Well, it is a problem, because when you become the boss and the only employee, there's no taking off, particularly in some kinds of business. Now, other kinds of business, you can take off as much as you want. Obviously, it can affect your business, but you've got to have financial responsibility, and you are responsible. There's nobody you can say, hey, he did that, or it's his fault. It's all you. And if you're ready to take on that role, then that's a good thing for you. Limited job security. Well, you've got secure that you're not going to fire yourself, but you may run out of money. And that could be a problem. Isolation and loneliness for some people that work by themselves, they just get tired of working by themselves. They like the camaraderie and the ability to communicate with other people in the job. And so that's always a good thing. Here's a big one of the negatives is it usually takes money to get started in a business. And this is why a lot of people don't start their business, but when they do. Now, I got to explain my slides here. One of the things that I talk about is the people around you. When you do take that first step and do start hiring people, you got to hire really good people. You can't hire dingbats, or in this case, clowns. They can take your business down so fast it'll make your head swim. So be careful about that. So typical employment gigs that pay 1099 income could be freelancing, writing, graphic design, sales, commission salesmen all over the place. Realtors, perfect example in the real estate business. There's even loan officers that are still 1099. Gig work, Uber, Lyft, or TaskRabbit, which I have no idea what TaskRabbit is. Consulting, providing specialized expertise, say like an architect or specific things that you have high knowledge to help people do things. Independent contracting, gosh, electricians, plumbers, painters, sheetrock, carpenters, the list could go a mile long on that kind of stuff. And then there's the temporary or seasonal work, could be event staffing or retail when the season is. And there's probably a bazillion others that I didn't mention that get 1099 and struggle with, because as a 1099 employee, they don't take out any of the taxes. Well, I think that's a good thing, but it does put you in a position where you have to do it yourself. So if Sandi was here, she gave me a list of questions to say, since she's not going to be here. And the first one for self-employed or 1099 employees: how do I qualify for a mortgage with variable income streams? Well, that's a good question. We're going to cover some of that. But when you have variable income streams, that you have multiple ways that the money is coming to you. That means you need to have a history, preferably a couple-year history of consistent income, whether it be from multiple factors. What documentation do I need to provide as proof of income and stability for mortgage approval? Well, we're going to talk about a lot of that, but obviously if you have tax returns and you show enough income on your tax returns to qualify, that is where you stop. You don't have to do anything special. You just show them how much money you show that you make to the government. And when you do that, you can qualify. But there are a bunch of different ways, and we're going to talk about those in the next few slides. Can I use business assets or accounts for down payment or reserves? It's a great question. So in many cases, you can use the funds from your business, but you generally have to get a CPA to write a letter stating that taking the money out of your business will not negatively affect your business. So just be aware of that, but definitely you can do that. Will lenders consider my self-employment history and longevity in the industry when assessing my mortgage application? Absolutely. That's exactly what they do look at. They want to see that you've been able to sustain yourself and have that stability of an income flow that is consistent, that's allowed you to hopefully save some money and have a good tax return, or maybe even bank statements, which is one of the main ways that you use when you can't do it with the tax returns. How can I improve my credit worthiness as a self-employed individual to qualify for favorable mortgage terms? Well, you want to have the best credit scores you possibly can. And credit scores do play a role for self-employeds as to how much money it's going to cost them when they put their down payment. There is a different kind of different layers that as you go up in credit scores, you put less money down. It's basically a risk versus the reward. And the higher the FICO score or credit score, the better you're going to look to the lender. They're going to have more faith that you're going to pay them back. And that's really all that they care about. Now, if you have lower credit scores, that doesn't mean you can't do one of these loans, but you may have to bring more money to put down. Are there specific mortgage programs or lenders that cater to self-employed individuals or those with non-traditional income sources? Yes, those are called non-QM mortgage lenders. There are some companies that do conventional and FHA and all that kind of stuff and non-QM. And then there are specific companies that just do the non-QM stuff. So there are a lot of guys out there that specialize, and there are a lot of lenders out there. So what are the implications of using a cosigner or joint applicant on my application as a self-employed borrower? I think it's a great idea. What that helps is particularly somebody that has W-2 income and and they can add their W-2 income to your self-employed income. That could be, they may cover the whole uh, qualifying part and just use you as a co-borrower without income. So I think that's a great strategy, and you can definitely do that. Is it hard to get a loan if you are self-employed? It's harder. It's not impossible. Um, I think that self-employed people are not favorably treated in the mortgage industry, but it's just because they probably they're being self-employed is a tricky deal by itself. So the lenders are naturally have to consider the risk, and some of them have been burned, and so they kind of go by that experience. And then finally, how do I prove income when I write off many of my expenses? And yes, that is the biggest problem for most people that are self-employed. And one of the benefits of being self-employed is you can live out of your business. I mean, you can generate a lot of money, but you can use all that money to live, pay for cars, pay for uh, property, pay for anything that you do, whether it's food or entertainment or whatever. Yeah, you can spend a lot of money, so build, honestly, doing good for your business and not leave a lot left for the tax man. Of course, the benefit is you don't pay taxes, or you don't pay as much taxes. So, excuse me for this silly cough. All right, so those are the questions. Hopefully, we're going to answer some of those. So the key thing, this is kind of a big deal, the 4 C's you must have. Now, some people say it's the 3 C's, some people 4 C's, some say it's the 5 C's. These are the 4 C's that I'm going to tout in this one. And the first one is character, and that's history of paying your credit obligations. This could also be credit. Okay, so character and credit are pretty much the same, but really you've got to have a history of paying the obligations that you go out and seek. Capacity is for borrowers' ability to repay the loan. In other words, you have enough income to pay the debts that you have been obligated on. And wouldn't that be interesting if our government had to do that? If they, anyway, don't get me started there. Capital, money for down payment and reserves. One of the things that an underwriter is going to look at is, are you scraping by paycheck to paycheck or dollar for dollar, or every time you get a deal, you spend it? They want you to have been able to build up some reserves, because when you buy a property, you probably are going to need to have, you're going to fix stuff, and you're going to need repairs. You're going to have things to happen. And I promise it will happen. Next one is collateral. What is pledged to the lender if for some reason you don't pay? And in this case, the real estate, if we're talking real estate, you have the property as the collateral. So if you don't pay, they take the property back. So those are the 4 C's. And you can see 5 C's. I think that the credit is probably would be the 5th C. So anyway, that's where you start. And that, whether you're self-employed or not, character, that's your credit. Capacity, ability to show income, capital, that you've accumulated some money, and then collateral is the property that you're buying. Okay, so what will lenders accept for income? And here's a quick list. Tax returns, bank statement programs. These are interesting programs where you would show the underwriter either 12 monthly bank statements, or even better, 24 monthly bank statements. What they're going to do is they're going to add up the deposits in each one of those monthly bank statements, and then they're going to divide it by a factor. And it just depends on the type of business you're in. But an example would be, let's say that you deposited in your bank account, let's just say $12,000, approximately $12,000 a month. Okay, times 12. That means that you'd have $144,000 of deposits into your account. And let's say that they gave you a 50%, which is a standard number, as an expense ratio, then that would be $72,000. And that would leave you with $72,000 worth of income based on this 12 bank statements that you gave them. Obviously, if you have more, it's better. If you have less, it just reduces your income. But that is one of the ways that the non-QM guys figure that. Co-borrowers as a non-occupant co-borrower, we talked about that. Profit loss signed by a CPA. So this is having your CPA do a profit loss for you and sign it, kind of verifying that it is an honest statement of how your income works. And that is working now. How about 1 year of a 1099? This is very aggressive. When you work for somebody in a position like a contractor or even a realtor or anybody that you're working for somebody, but you're working as a contract employee, you'll get a 1099. And when you get the 1099, it'll show your gross income. Now, what most people would do is they would take that gross income and they would write off any of their expenses. And the bottom line, after they took the expenses away from that gross amount, that would be the income that they'd pay the taxes on. Some of lenders are going to give you the benefit of using that 1099 and probably an expense factor not dissimilar from what happened on the bank statement program, and that would be an income. No income DSCR. This is the loan, and particularly an investor loan, where you use the debt service as the income. So what happens is if you have a property that you can rent for, well, let's say your payment on it is $1,500 and you make $1,500 rent, then you don't have to verify your income on that. Here's when I was doing my research on this, I saw this stated income, and I haven't seen a stated income loan in a long time, but they're starting to bring it back. And this is where you state your income. And if you have good credit, you have the ability to borrow money based on, I make $20,000 a month. And they look and they go, okay. And there's obviously some evidences and proof of this, that, and the other, but it's stated income. And then one of my favorites that I've used multiple times, one, because I like it, and it is a conventional loan product, is a asset utilization program where you may have, let's say, $1 million in a retirement account, but you don't have any income. You don't get 1099s. You may take disbursements from that, but they will allocate you an income based on the amount of money that you have in a retirement account or in some kind of account. Now, some of these are age restricted and some aren't. So on the non-QM side, they're a little more aggressive with giving you the income on that. As you get into conventional mode, it's less so. But just having that money, you're not stuck, and you are able to get a loan, and the asset utilization is a really good program. So, okay, so let's look at it. What I did is I put the profit loss, the Schedule C here. Let me see if that can, I didn't blow it up too much, but the Schedule C shows your gross income from whatever you're doing that you're getting paid for, and then it lists the expenses here, and this is maybe not all of them. One of the things about a profit loss is you can add back in to your income the depreciation and what is it? There's another part to it. I don't remember, but the depreciation and depletion, I think, is what it is. So that's one. And then I've just got a picture of a bank statement over here. All right. You will not qualify for a loan if, and then I dated myself a little bit with danger, Will Robinson, danger. And that's a old movie that's been renewed, but it was a pretty cool movie and series that I used to watch when I was a kiddo. Anyway, if you have insufficient income or they can't verify your income, guess what? You're not going to get a loan. Low credit score, it's particularly on the non-QM stuff, you're just not going to get a loan. foreclosure or bankruptcy, well, this is a maybe. Depends on how long ago the foreclosure or the bankruptcy was, but they're not looking for doing a loan with anybody that's had recent foreclosure or bankruptcy. And then this unverifiable income is probably the same thing as that one. And then less than 2 years self-employment history. They want you to be self-employed for at least 2 years and longer, if you can, to just show that. I think there's some stats about people that about 50% of the people that start out last 2 years. I think it actually goes up to 5 years. But after 5 years, I mean, it's hard to stay employed for yourself. So you have to be careful. The lenders are aware of that kind of stuff. Now, here's a couple questions that I didn't see on there that I want to answer anyway. What if you go from being self-employed to W-2? Well, if you do that, you can get a loan 30 days after you've got your paycheck stub from the W-2 person. What if you went W-2 to self-employed? You got to go 2 years. All right. So going from W-2 to 1099, not good for buying a house. Going from 1099 to W-2, you're good. That ought to work. All right, let's see, get back here. All right, what you need to know about non-QM loans. Well, interest rates are higher. They're higher than normal conventional rates, and maybe 1.5 points, maybe 2 points. Down payments could be higher than normal conventional loans. So most of the non-QM stuff, when you're doing the self-employment stuff, you're usually minimum is probably about 10% down. And so you just have to be aware for that. And the reason for that is their risk for the lender is higher. So they, what they're going to do, let's say you put 10% down, if they have to take the property back, they can only really expect to get about 80% of the value of the property back. So they're going to lose. That's why the higher risk that they have of losing, they're going to require a higher down payment. All right, so here's a group of programs that I got these flyers from some of the companies that I get a chance to work with, and they're kind of cool. So it tells you here, help your clients pay down debt with a closed-end second, up to $750,000. So on this one, if you have a debt ratio that's too high, they'll actually lend you the money to pay off and lower your debt ratio. I thought that's an interesting look on it. I'm not sure they can do that in Texas, but they may. Bank statements loans. Minimum FICO, 680, max debt ratio, 50%, minimum loan amount about 100,000, 100,001. Obviously they do full doc, and then these guys will do 1 year 1099, kind of the same way that I told you that the bank statements, they're going to look at how much money you made and they're going to give you an expense factor. Tells here the CLTV, that's combined loan to value, is as high as 85%. So in this one, it looks like it's about a 15% down. Here's a 12-month bank statement loan. This one, with a higher FICO, you can do up to 90%. With a 680, you can do up to 85%. And with a 660 FICO, you can do 80%. So you'd be putting 20% down. They have the 2-1 temporary buy down, which it could be helpful in that, as low as 15% expense ratio. Now that's a very low expense ratio based on most businesses are at 50. And it says here standard is 50% expense ratio. Must have 2 years self-employment history, and your personal bank statement equals 25% minimum ownership. So that's saying that if it's a business account, you have to have at least 25 minimum ownership. And then they have another one where business bank account, 50% of the minimum ownership. So that's an example of a flyer. I got a couple other here. Alt docs, loan amounts up to $3 million. Wow. 700 FICO, 2.5 loan amount with 680 FICO. So that's 75%. They'll do cash out up to 75% on all products. Let's see. I'm going to try to make this one a little bigger. Let me see if I can do it real quick. And go here. And then do that. All right. So this one, bank statement loan is 12 months required, no tax return required, no W-2 needed. That's cool. Qualifying income is determined by one of the following methods: fixed expense ratio of 50%, and then another expense ratio by a third party CPA with a minimum as low as 15%. So if you had proof that your business had a lower expense ratio and you had proof of that, then they would allow that. And obviously that would show you more income. P&L loan, 12 months CPA. Let's see, it's got a bunch of letters out there. I'm not sure what those are. Must attest they have prepared the borrower's most recent 2-year tax returns. Again, this is a profit and loss loan. So what you're looking at is the CPA probably producing this form for you and signing that it is the real deal. Max DTI is 50%. That means your debt ratio can go up to 50%, up to 80% loan to value on a purchase, 75 on cash out, and no tax return or transcripts required. 1099 is probably going to be the same as the bank statements. Yeah, it's got various things there, up to 90% on that with a good credit score. And then the asset utilization are divided. Check this out. So the money you have in the bank, they're going to divide it by 84 months to determine your income. That's pretty low. 100% of checking, savings, and looks like savings accounts. And it just has different percentages of what you can allow for each one of those asset groups. So that's kind of interesting. A lot of options here. I-10. Well, what if you don't even have a Social Security card? You just have an I-10 number. No reserves required. They only use TransUnion FICO. Gift funds are allowed. Doc types, profit and loss, or full doc, but no FICO required. You don't have to have a credit score. Debt to income up to 55%. That's consistent with the FHA. Minimum FICO on Premier 680 up to 85% loan to value. DTI up to 55%. Wow, these guys are very aggressive. And then here's one that I like, and we use it, a fix and flip program. This could be for investors. As a matter of fact, I think this is specifically for investors, but they do loans up to $5 million. And fix and flip and bridge only loans, stated income, no income verification, that's probably the DSCR part, up to 80% loan to value plus 100% of the rehab budget finance. So what you do is you're going to go and you're going to look at a property and you're going to decide what you're going to do to it, what rehab budget you're going to assign to it. You take that budget or the proposal to the lender. The lender's going to take it to an appraiser. The appraiser is going to look at what you're going to do and the property, and he's going to tell you a number of what that house would be worth, or that business or whatever it is you're doing, how much that would be worth after you did this rehab on it. And they would lend up to 80% of that and include all your rehab budget. So that's a great way to go. Loan amounts up to $5 million, minimum FICO 650, no upfront origination fee. What? Crazy. No seasoning or sourcing of assets, no reserve requirement, no prepayment penalties. Wow, this is really an aggressive program. So that is kind of cool. Now, I do think that that's the last one that I have as far as programs, but let's just see what else I've got here. Okay, so here's what we covered. And this is kind of bring to the end, and I think I allotted about my 30 minutes is what I gave myself. Here's what we covered. We talked the challenges faced by small business and why go into business as a self-employed person. Tax write-offs and low reported income, impact of loan eligibility, alternate loan options and sales options, financial planning and preparation, conclusion, and questions. So I will wait for a minute and see if there's anybody that in the chat has any questions. And I don't see that. Very good. Okay, I don't see any questions coming in, so I will sign off, but I want to thank you for attending, taking a look at this. If you're self-employed, call me. This is way too quick to go over an analysis of what your income might look like or what you'd qualify for. Obviously, you see my number scrolling across the bottom of the screen. I look forward to working with you. Man, I love those self-employed guys and what they bring to our community. So anyway, thanks a lot. We're signing off. We'll be back next week, and I will talk to you soon. All right. Bye-bye.